Today, we're digging into Fannie Mae's latest report card for Q3 2025. We're going to get the story straight from their chief financial officer's perspective, which gives us a pretty rare look inside the engine room of the U.S. housing market.
All right, so here's how we're going to break this down. First, we'll hit the big headline numbers. Then we'll get into exactly how they make their money. After that, we'll look at the challenges they're up against. And finally, we'll see what their game plan is for the future.
So how did one of the biggest players in the mortgage world actually do last quarter? Let's jump right into the number that matters most. $3.9 billion. That's their net income just for the third quarter. I mean, wow, that is a massive figure. And it's up a solid 16% from the last quarter. That shows some really strong momentum.
Now, what's really interesting here is the picture this paints. It's one of steady, solid performance. You can see revenues were pretty flat, but their net income and return on equity both went up. And most importantly, their net worth grew to over $105 billion. They're just consistently building up that financial foundation.
And look, these aren't just numbers on a spreadsheet. That financial performance directly translates into providing $109 billion in liquidity. That helped over 400,000 families buy, rent, or refinance their homes. It's just a powerful reminder of their real-world impact, especially for the 207,000 first-time homebuyers they helped out. So, how does Fannie Mae actually bring in all this cash? Well, it turns out it's powered by one very consistent, very durable core engine. A whopping 81% of their net revenue comes from just one place: guarantee fees. This really shows you just how focused and consistent their business model is. It's not about flashy one-off things. It's all about that steady, predictable stream of income.
So here's the key. Think of it like this. Fannie Mae is basically an insurance provider for mortgages. Lenders pay them a fee, and in return, Fannie Mae takes on the risk that someone might not pay their mortgage. That insurance premium, that's what drives almost all of their revenue.
But this engine really has two very different parts. You've got the huge, stable, single-family business, that's the bulk of their portfolio, and then you have the smaller multifamily business, we're talking apartment buildings, which is growing, but as we're about to see, it's starting to show some signs of stress. Okay, so no business operates in a perfect world, right? Fannie Mae is definitely facing some big pressures from the wider economy, and these challenges are really starting to pop up in one specific part of its portfolio. While the overall financial picture looks strong, if you zoom in on the loans for apartment buildings, a totally different story starts to emerge. This is where we see some growing stress. You can see it right here on this chart. The number of seriously delinquent multifamily loans went up by 7 basis points. That's 0.07% in just 3 months. Now, that might not sound like a huge jump, but it is a clear and measurable uptick, and you can bet they are watching it very, very closely. And you don't have to take my word for it. The CFO herself, Priscilla Almodovar, explained exactly why this is happening. It's a mix of things: sustained market pressure on property owners, plus a slowdown in how much they can raise rents. You know, when income flattens but costs keep going up, something's got to give. Now, on the much bigger single-family side of the business, the challenges are different. It's less about people not paying and more about simple affordability. This is slowing things down and leading to a slight increase in the debt-to-income ratio of new buyers, which just means more of their paycheck is going towards debt.
So you've got these strong results, but you've also got these storm clouds gathering. So what's Fannie Mae's strategy? Well, the CFO was crystal clear, and she laid out a really simple, disciplined, 3-part plan.
It really doesn't get more focused than this. Their entire strategy boils down to 1. Manage costs tightly, 2. Keep every dollar of profit they make, and 3. Use that money to build a much stronger financial foundation for whatever comes next. And hey, this isn't just some goal for the future. They are acting on it right now. As the CFO pointed out, their non-interest expenses are already down 8% in just 1 quarter. That's because they have a laser focus on being more efficient. This shows you exactly why building up that capital is so critical. Even with a net worth over $100 billion, they still have a regulatory capital deficit of over $25 billion. That's the gap they are working relentlessly to close. So the whole point here is that every single dollar they earn and save is aimed at one goal: building a massive capital buffer. And this isn't just about checking a regulatory box. It's about creating a fortress that can support the entire housing market through a really bad economic downturn. So to wrap it all up, the CFO's message was really one of quiet confidence. She basically said that the strong, consistent earnings from their core business,
That's what gives them the durable foundation they need to build resilience for the future.
And that leaves us with one last big thought. This super disciplined, almost single-minded strategy of building a financial fortress, well, it points to a clear preparation for future economic stress. And that makes their actions a key thing to watch for anyone interested in where the U.S. housing market is headed.